All right, let's pull back the curtain on one of the biggest, most important concepts in all of trading, market liquidity. But we're not going to give you the boring textbook version. We're going to look at this through the eyes of the giant, multi-billion-dollar institutions. You know, the ones who are actually moving the market. First, I have a question, and I bet you know the answer. Have you ever found the perfect trade? You set your stop loss exactly where you're supposed to, and then, like magic, the price dips down, hits your stop to the penny, and then immediately turns around and flies to your target. It is infuriating. It feels personal, right? Well, what if I told you that wasn't bad luck? It wasn't random at all. It was actually by design. And that leads us to this, which is really the core idea of everything we're talking about today. It's a powerful and kind of brutal truth about the markets. You're either the one who understands where the money is, or you're the money that gets taken. Our goal is to make sure you're on the right side of that equation. So here's how we're going to break it all down. First, we'll cover the billion-dollar problem that institutions have. Then we'll go hunting for liquidity where they find it. After that, we'll dissect something called a liquidity sweep. Then show you how to trade with the giants. And finally, we'll lay out your path to mastering all this. Okay, let's dive into section 1. Here's a wild paradox for you. As a small retail trader, getting your orders filled is the easiest thing in the world. But for the so-called smart money, we're talking massive hedge funds, it is their #1 single biggest problem. So let's get a really simple but crucial definition down. The market is just an auction, right? For every single person buying, there has to be someone on the other side selling. So think about it. When your buy trade hits its stop loss, what happens? You are forced to sell your position. In that exact moment, your forced sell order just became the liquidity for someone else to buy. Your loss literally becomes their entry. And this slide really shows you why it's two completely different worlds. If you're trading with $1,000, you click buy, you get filled instantly. You don't even think about it. But just imagine you're trying to buy $100 million of something. You can't just smash the buy button. The price would skyrocket against you before your order was even halfway filled. To get into the market, they need to find a massive pool of sellers. So the real question becomes, where do they find them? And that leads us perfectly into section 2, hunting for liquidity. See, these big institutions don't just sit around and hope they find enough orders. No. They actively go out and engineer the market to create the liquidity they need. And they hunt for it in very predictable spots. Here are 2 really great ways to think about this. First, liquidity is like a magnet. Price will naturally get pulled toward areas where there are tons of orders, like, stop losses. And second, think of it as fuel. A market can't make a huge explosive move in one direction without first gassing up. It needs to grab a ton of liquidity to power that next big leg up or down. So, where are these gas stations? Well, they're in places that are going to look awfully familiar. We're talking about equal highs and lows, swing points, trend lines, and clear support and resistance levels. If you're thinking, wait, those are the exact patterns my trading book told me to trade, you're right. And trust me, that is not a coincidence. Let's walk through a classic example. You, the retail trader, see a double top. Price comes up to a level, pulls back, and then fails to break it a second time. Every textbook on earth screams that's a sell signal. So you go short, and being a good, disciplined trader, you put your stop loss just a little bit above those 2 clear highs. Makes sense, right? Well, an institution sees that exact same pattern, and they see something completely different. They don't see a reversal signal. They see a target. To them, that double top is just a giant flashing neon sign that says, "Free money here!" It tells them exactly where a massive pool of stop-loss orders is just sitting, all stacked up and waiting to be taken. Okay, so let's get into section 3 and see exactly how they take that money. We're going to look at the anatomy of a sweep. This is the actual move, the engineered trap that they use to capture all that fuel they need for their real move. It all starts with the bait. The market will create a really clean, obvious level of support. Price will bounce off it once, twice, maybe 3 times. This builds confidence. Retail traders see this and think, wow, that's a safe place to buy. So they start placing their buy orders, with their stop losses all clustered together just below that safe level. And then comes the trap. Smart money will aggressively push the price below that support level. Now, this move is brilliant because it does 2 things at once. First, it triggers all the stop losses from the people who bought at support, forcing them to sell. Second, it tricks breakout traders into thinking support has broken, so they jump in and start selling too. You get this huge cascade of sell orders hitting the market. And who do you think is on the other side happily buying every single one of those sell orders at a discount? The institutions. They just manufactured their own entry. And finally, step 3, the reversal. As soon as their huge buy orders are filled, the real move begins. Price aggressively reverses and shoots higher, leaving both the people who got stopped out and the people who got trapped selling in the dust. That's the stop hunt you've probably felt before. It wasn't bad luck. It was a planned liquidity event. So the million-dollar question is, how do we stop being the fuel for their fire and start trading alongside them? Well, that's what Section 4 is all about. This is your new playbook. Okay, here's a simple 5-step checklist you can start using. 1. Always identify the overall market structure first. Are we in a bigger uptrend or downtrend? 2. Mark out the obvious liquidity zones on your chart, those clean double tops and bottoms. 3, and this is the most important part, wait. You have to be patient. Wait for the sweep to actually happen. 4. Look for confirmation that the trap has been set and the real move is starting. And then, and only then, step 5, plan your entry and your exit based on that confirmation. Now, I have to make this crystal clear. Understanding liquidity is an absolute game changer, but it's not a standalone strategy. It's a confluence. It's like the secret ingredient. When you see a liquidity sweep happen right into a key supply or demand zone, and it also lines up with a higher timeframe market structure, that is an A+ high probability setup. It's a final piece of the puzzle, not the whole puzzle itself. All right, for our last section, let's just quickly lay out a roadmap for you. How do you actually take all of this information and start to apply it in a smart, methodical way? Think of it like building a house. You have to do it in the right order. First, you build a solid foundation. In trading, that is mastering market structure. Full stop. Once you have that, you can build the walls, learning to identify true supply and demand zones. With those 2 pillars in place, then you can start looking for the simple traps, the obvious support and resistance sweeps. Only when all of that becomes second nature should you even think about moving on to more advanced stuff. You gotta build it from the ground up. So we end right back where we started. You now see the game that's being played behind the charts. You understand the hunt for fuel, you see how the trap works, and you know why those stopouts happen. The market itself is the same. The only thing that's changed is you. Now you know the rules, so the choice is yours.